Wall Street Media. This is Marley. I'm here with Doug, and we'll help you make money in the stock market with information you can't get anywhere else.
Hey, we have two good ones. ValueClick we work with
do.
a lot.
Great clips, yeah.
And smart guy, Gary, I think his name is, that I've been chatting with for years, right? Smart, and they just keep building, making acquisitions, bolting things on, and doing well with them.
They seem to have a really good plan, too. Again, like Doug said, it's the third annual Needham & Company Internet and Digital Media Conference, and we have ValueClick. We have their president and CEO, Thomas A. Vadnais, and their ticker is VCLK. Discusses the growth of online advertising and the company's four main business channels: media, affiliate marketing, comparison shopping, and technology. Here it is.
If you look at the industry we're in, it's been a great industry in the sense that there's a continual shift of dollars from offline traditional advertising to online advertising. And based on eMarketer data from February, and it hasn't changed much since then, the U.S. ad spend online will be over $26 billion this year, up from $21 billion last year, and going to $31 billion next year. So this growth in online advertising spend is significant and is a combination of organic growth from customers who are simply spending more each year online, and some shift of dollars from traditional offline advertising. If you look at the shift portion of that, this graph represents, again from eMarketer data, the percentage of total marketing spend in online advertising. And you can see that percentage of total marketing budgets has been going up each year. So the 9% this year, 10.3% next year, and so on are the projections. The curve seems to be pretty standard in the uplift it's getting every year as more traditional dollars are shifted to online. I've talked about our four business segments. Here's a quick rundown of each of those segments in terms of how they're positioned and what businesses we're talking about. I mentioned our media business is the largest segment that we have, over $300 million in revenue this year. It's a combination of our display ad network, our lead generation business, and our email business. It's one where we have an unusual thing happening this year. We're not going to show growth in this segment because the lead gen channel across the industry has slowed down considerably from highs last year, and we're not seeing that channel growing, and as a result we're seeing some decline in overall revenue in that media segment. The other channels are growing nicely, and we're hopeful the lead gen channel will continue or will come back into a growth pattern in the third and fourth quarters. Our affiliate marketing channel, $153 million. These are all worldwide numbers. Year-to-year organic growth in the low teens. It's our highest margin segment, 40% or so operating margin. And back to the media for a second. Well, we aren't seeing growth there. It continues to be a very profitable channel for us, as really all of our channels are. Third channel I mentioned, comparison shopping, $200 million worldwide. Fastest growing channel that we have this year, and again margins in the low to mid 20% range. And finally our technology channel, smallest in terms of revenue, a very high margin business, mid to high 30% range, and our growth of mid-teens, that's probably understated in terms of at least what we're seeing in the first quarter results. We think we'll have greater growth than that this year in our technology segment.
And we have Scott Melland, the president, chairman, and CEO of Dice Holdings, Inc. Their ticker is DHX. Discusses their plans to grow by maximizing customer opportunity, expanding within their present markets, and pursuing acquisitions in related fields.
So how do we expect to grow this business? What's our strategy? It's actually fairly simple strategy that we have. The first mission in the company today is really to maximize the customer opportunity that we have. I mentioned earlier that with Dice, we serve about 9,000 customers on a monthly basis. With eFinancial Careers, we serve about 2,000 customers on a global basis. If you look at the opportunity in those markets, we're really talking about an opportunity that's tens of thousands of customers. And so we literally have, the mission right now is to go penetrate that market and bring in those customers. The second part of it, though, is for the customers that we do have, is building out the wallet share, our share of budget, of recruiting budget within those customers. And I just put this up here as an example of how we build our relationships over time with customers. This is an example of a large, actually U.S.-based financial services company. And you can see that over the years, what we've been able to do is go from selling our service to a single division of the bank to selling multiple divisions of the bank, and then also cross-selling our products within the company. This is obviously a strategy of ours and presents a nice opportunity for us going forward. So maximize the customer opportunity in the markets we're in. The second tier of our strategy is to expand the markets we're in with our core technology and financial services franchise. I'll give an example. So with eFinancial Careers, we're in many of the top capital markets across the globe today. We're not in all of them. I think you can expect that we will be in all the major capital markets over the coming years. And this year alone, we'll add 3 markets to that business. For Dice, if you look at technology recruiting, it's one of the largest recruiting verticals globally. Today, we only participate in that business in the U.S. We plan to expand that franchise outside the U.S. And see where that takes us. And then finally, the third part of our strategy is to pursue acquisitions in related fields, related communities, related employment categories. And, we essentially see opportunity in other professional categories that we're not in today, or categories that lend themselves to a category killer type service like we have. And we've been very disciplined with our acquisitions over time, and we feel comfortable with that.
These guys just came public. Looks like last summer, Marley. They're down at $6.49 a share.
I don't know a whole lot about them.
They bounced back up. Exclusive job stuff. I see them around. I think I see them on Forbes and Fortune.
I listened to their whole presentation. It was very interesting.
And I know who they are. They're just getting started. He was saying that everything seems to be going wonderfully. And they bought a new site for security clearances, right?
That was really interesting because right now, what is it, 2.5 years, the wait to get your security clearance?
And he said they earn more in EBITDA every year than they paid for it, right? So that sounds like a pretty good deal, right?
Besides that.
Smart acquirers. If you guys own Dice or if you own ValueClick or competitors, click the feedback button
and let us know.
And let us know what you think about them, how they're doing, why you like them. And we'll have many more of these. We have 20,000 of these a year.
We do. Well, we're here every day at Wall Street Media. You can find us at WSMCO.com. Thanks for joining us.